Welcome everyone to the Directed IRA podcast with Mark Kohler and Matt Sorensen. This is Matt Sorensen. Just want to get, make sure you know my voice, hear my voice, hear me. I just want to be heard. And I'm with my amazing partner, Mark J. Kohler, the guy that told me what a self-directed IRA was.
Well, thank you. I will. That's about where it left off. And since then, running the show. So no,
Mark was my Obi-Wan Kenobi, taught me the Force.
Got you. I walked you through the basics, here's your saber, go kill the Death Star. So yes, my name is Mark Kohler and so excited to be here with you. We just the summit was a month and a half ago and it seems like yesterday. And we had so many amazing questions and involvement from people around the country. The Directed IRA Summit in October will be in Phoenix. I really encourage many of you to put that on your calendar. We're going to have a golf tournament and more speakers, and we just are getting better at this. And we thought we were pretty good before, but you just get better when you do it over and over.
I know there's 2 seasons of summits live got missed. So, we were out of practice a little bit, but we're getting better and better, getting on our game, and put a lot more networking and social activities. We're trying to have a little more fun. If you saw the Crypto Tax Summit, Mark got up on the drums with the band. I got on the guitar. We actually literally played with the band at the party after the Crypto Tax Summit. So, we're trying to keep it a little more fun.
Are we going to have a band at the SDIRA Summit?
I mean, I think we just need to get that on the agenda.
Yeah, we got to round table that one.
We might have our own band by then.
That's true. Oh my God.
We're looking for a band name. Anybody's got some band names? Send them our way. We are in the hunt for a band name.
Yeah. Oh my gosh. That's what you need is just a band of a bunch of lawyers and accountants. It's going nowhere quick, but thanks everybody for being here on Open Forum. This is the show where we field many of your questions from around the country. We're putting a new plugin at SDIRA,
directedira.com/podcast.
directedira.com/podcast. I wish we had a better little spot for that, but you'll be able to submit more questions in the future. We're really making sure that plugin works better for that. We'd love to get the comments going back and forth with many of you in that chat. So that's we'll be unveiling a new format for that, but we've got a ton of questions right now in the hopper. So I think many of you will find something very insightful that will impact you today. And Matt, I'm going to let you be the lead batter. You got something?
All right. Lead off hitter. Like it. I'm going to try and just get on base. All right.
Okay.
Get on base. All right.
Jonah, why do we want them?
Because he gets on base. How come you always get to be Brad Pitt in that one? And I got to be Jonah Hill.
I don't know. That's odd. I never noticed that.
You always pick Brad Pitt. You got the Jonah Hill lines. I get the Brad Pitt lines. All right.
Yeah. Well, okay. It is what it is.
Yeah. Okay. It's 50-50. What are you? Okay. All right. This question was from David. And I like David's question. From a little town. I don't know what that means, David, but he says, hi, Matt and Mark. I had a question about solo Roth 401k rollover transfers. I know you can transfer a Roth.
Say that again for everybody. That was a mouthful. It's a question about
solo Roth 401k rollovers and transfers.
Okay.
Yeah. I mean, might have been a curveball here for the leadoff batter, but he says, I know you can transfer a Roth 401k into a Roth IRA if you have a triggering event such as turning 59 and a half or ending employment. If you have your own S Corp that started your solo 401k, can you dissolve that S Corp with the solo 401k and open a new S Corp for the same business? That way you technically have ended employment and it is a triggering event. Is it more trouble than it's worth? Is this not worth the hassle? Thank you. Okay, let's give a little context to this question, and I want to make a couple points, and then I'll get to David's question, if you don't mind. First, yes, David, you can roll a Roth 401k into a Roth IRA. Now, I want to make sure everybody knows you cannot do the opposite. This is a stumbling block a lot of people hit and run into. If you have a Roth IRA, you always have a Roth IRA. You can never go the other way around. You can never go Roth IRA into Roth 401k. We have a lot of solo 401k clients that are like, all right, I got my solo K and I got my Roth account. I want to roll my Roth IRA into it now. Can't do it. Doesn't go that way. It's a one-way street. But what David's trying to do is Roth 401k to Roth IRA. And that's okay. You can go out. But now what David is mentioning here is a tricky thing. When you have a solo 401k, you can't just roll money out to IRAs whenever you want. It's still subject to similar rules. Like when you have your big employer 401k that you're an employee, you can only move money out to an IRA when there's a type of triggering event.
Now I want to add something else too that may help with the question here, Matt. It's not so much terminating the S corporation as much as terminating the 401k, which could be easier. Couldn't David in this situation just say, I'm going to terminate the 401k, keep the S corp alive and well, roll out whatever I want to roll out, and then set up a new solo when the time's right or whatever? Would that work?
That's exactly what I was going to say.
Oh, really?
That's exactly, I mean, David, do not shut down your S corp if you don't need to. I mean, you're still in business. Maybe if you really are stopping that business, you could do that. But closing the plan is another reason when you can roll out. So just close out the solo K plan, roll it out to an IRA. Now, if you're like, yeah, but I want to do a solo K again, there is actually a window you have to wait though. I believe it's 2 to 3 years when you close out a 401k and then go into a new one. So it's not like you'll be able to close out, roll to an IRA, and that same year go open up a new solo K. So there's a little catch there if you try to go down that path.
Is that because it's the same company? Is this going back to the original? Yes. So maybe dissolving the company would have to happen to get around that window.
Exactly. So that might be step 2 if you're like, but Matt, I want to contribute next year and do the large solo K contributions. Okay. Then you do need to do that 2-step process of closing out the plan, closing out the S corp, then doing a new entity and everything, which may be worth the gymnastics. I don't know. Seems like a lot, quite frankly. But it could be possible to enable you to roll out to the Roth IRA. Now, I would want to know, why do you need to roll out to the Roth IRA in the first place?
Yeah, I was just going to go there. I was like,
because the only time I say to do that is when you're 72 and you have to start taking RMD in a solo 401k. But when you're 72, you've hit the 59.5 rule, so you can roll out whenever you want in the 401k. So,
yeah, and here's the thing, people. Let's step back. I probably should have led with this rather than answering David's question. Is just look at it on the face of it: a Roth 401k versus a Roth IRA. Well, frankly, I like the Roth 401k better generally because I don't have UDFI to worry about, and which is going to be in the next question I want to field. And you're able to set up LLCs. You can set up all sorts of unique investment strategies with the latitude of your solo 401k as the trustee. I think they're just easier. So I'd really want to know what the rush is to get it out to a Roth IRA, because you can't put it back once you roll it out. So,
yeah. Yep. Okay. You got a UDFI question then?
Yes. Okay. So this is
sounds fun.
Yeah, that's pretty good. Okay, everybody. So this is Eric, and I like this because I think it's going to relate to a lot of you that might have real estate deals going on in your individual life versus your IRA. So he says, if one's Roth IRA were to own part of a short-term rental with an IRA LLC that average stay of less than 7 days, would profits be subject to UBIT or UDFI? Now let's get all the question on the table. In this scenario, the Roth IRA would put down the 20% needed to buy the property and own the majority of the LLC, while a partner would put very little down, personally guarantee the mortgage, and run the day-to-day management through the LLC, and get the depreciation as an ordinary loss, since the average stay would be less than 7 days, which I understand makes it a business and not a rental. All right. Well, Eric, you threw out a lot here. Let's kind of carve this up into pieces. First, you're hanging a lot on this 7-day rule. There's a little more to it than that. Basically, everybody, I don't want to freak you out. If you have an Airbnb rental under 7-day rental, it's still considered a long-term real estate investment, as just if it was a monthly, 6-month lease or annual rental. There's certain criteria that turns it into a hotel, and just saying, well, it's the average less stay than 7 days. So obviously it meets the hotel criteria. That is not correct. And if you look at my article from just, I think 2 blog articles ago at markjkohler.com, I talk about how short-term rentals are taxed. So that's point number 1. And let me just say this quickly. If you meet the criteria that it's a hotel / business, which I'm not saying you'd want.
Yeah. And usually it's not. Usually you can avoid that if you're doing it right.
Totally. You don't want that. And I know you're thinking, well, my partner that's signing on the mortgage, that's what they want. That doesn't make it an ordinary loss to them per se. And you're gonna shoot yourself in the foot for the Roth while trying to help your partner. And then you're talking about special allocations. Eric, you're being very creative here, which I applaud. Yeah. But okay, so point number 1, and I'm going to hand this to Matt. So point number 1 is you want to look at all the rules of what makes it a hotel classification versus a long-term rental classification. Just because it's an Airbnb, less than 7-day rental, doesn't make it so. Now, let's say it is a hotel, Matt. Would that generate UDFI or UBIT?
Yeah, so let's say you're more of a hotel, bed and breakfast type thing, services during the stay, all of that. Then yeah, you would have UBIT on the income coming in. But we have so many Airbnb clients that it's just rental income coming in. It's not subject to UBIT. Now, if there's debt on the property, that's another consideration we'll get to. Yeah. But just, do you have UBIT or not? Is this rental income or business income? So generally you can make it be rental income, avoid services during the stay and other things. Check out Mark's article. So, and that's good for your IRA because you don't want business income. You want rental income. Okay. It's exempt from UBIT.
Totally. And this partner that you've recruited to be your credit partner, you got to turn them around because they think they're going to get all these sexy write-offs and depreciation and all this crap. That's not in your best interest. And you don't want them thinking that. They're getting a heck of a deal just using their credit to be a part of this deal. Let them enjoy that ride. Don't make promises of ordinary loss.
Yeah. And you cannot special allocate. So when an IRA is involved, it gets the benefit of whatever percent of ownership it is in the deal, whether it's income coming to it, loss coming to it. You cannot be special allocating losses. And a lot of people think that, well, my IRA doesn't get depreciation and it doesn't get losses. Okay. Well, you can't special allocate that away to another partner who could. Okay. That doesn't work. Even if it's an unrelated person, it's not disqualified. Now, one other point I want to make on this, because I've been down this with other short-term rental clients, even my own, analyzing one of my own rentals I'm taking to a short-term rental. Short-term rentals usually have great cash flow.
Yeah.
What type are you going to really be able to depreciate and take that loss? If this short-term rental is getting great income, you're going to
have a loss.
Depreciation. You're not going to have a loss.
Yes. Yeah. And you're taking the risk of the volatility of a seasonal market. Airbnbs are not a guarantee that you're always going to make more money. But if they do, that's why you do them. And that's what you're trying to accomplish. You're not going to have a loss anyway. That's a theme in my article as well. Now,
what about the debt though? That's the one thing, the UDFI thing.
So let's take away this whole argument of, is it a hotel business classification versus long-term rental? Okay, let's just take that off the board for a minute. Something else that Eric said that he's doing, which I like, we have a lot of clients doing this. He said, hey, I'm going to put down the down payment through my IRA and have a non-prohibited party sign on the mortgage. Love it. IRA is going to own more of the LLC. Your partner's going to own a certain percentage for being the creditor. Okay, so now you have UDFI. And for all of you that don't know what unrelated debt financed income is, make sure you go back and listen to one of our prior podcasts dedicated to that whole topic. But how do we get around that? A Roth 401k. So if we go back to David's question just a moment ago, a rental project with debt would be perfect in a Roth 401k. No UDFI. We don't want UBIT. It's clean. It's tight. Your 401k is now the partner in the LLC, not your Roth IRA. And that's just a perfect way to get around this problem.
Yeah. Not everyone can do the solo Roth 401k, but a lot of people can pull it off. We got prior episodes on the solo K. If you're like, I don't get the solo K, you can do Roth accounts. We cover that in a prior podcast. So, all right. Well, that was a big question. Thanks guys for hanging in there with us on it. There's a lot of interesting parts in that. Okay. I got a question from Vivian. Vivian asks, I'm 54 years old. My children and I receive Social Security survivor benefits from the death of my husband, and I have no earned income for 2021, unless the profit from the sale of our home counts. The benefits are less than $25,000 for each of us per year. Are the Social Security survivor benefits considered earned income so I can contribute to a self-directed Roth IRA for 2021 or 2022? Doesn't matter, but no. Unfortunately, Vivian, Social Security benefits are not considered earned income, whether they're benefits in retirement or survivor benefits. So you need to have wage income on a W-2 or self-employment income on a Schedule C to have earned income. Now, the one caveat to that is HSAs, and that's another part of your question here. Health savings accounts do not have an earned income requirement. So that might be an option for you, Vivian, if you have a high deductible health insurance plan or you want to move to one, is you could use an HSA and contribute to an HSA for you and your kids. You could do the family, put over $7,000 a year into it, grows and comes out tax-free for your healthcare now or in the future in retirement. So the HSA might be a good option to use in your instance. And you could do an HSA LLC for crypto and some of the stuff you want to do in your account. So maybe look at the HSA in your instance.
Okay, so Matt, I'm just going to add a little more clarity on detail on what income qualifies to contribute to a Roth or IRA. Other income that may qualify is taxable alimony, stipend payments, whatever the hell that is, or disability benefits. But income that you can't use to contribute to a Roth or IRA is rental income, capital gains, IRA distributions, Social Security interest income, dividend income. Those can't be used to contribute to a Roth IRA. Now, if you have a small business, you're going to ultimately be paying some self-employment tax, and that's going to generate that income necessary to contribute. So good stuff. I think when some people want to contribute to a Roth IRA, I say maybe you get a director's payment from your kid's small business or your brothers or your mom or dad's, you know. So there's a lot of other things going on.
Yeah.
We can play with.
All right.
Okay. Now the question I liked.
Okay.
If I may.
Yep. You're up. You're batting.
Now I know this is it's a hard one, but we get this question all the time. We have to address it from time to time. And it's called the ROBS structure, ROBS. And this is something that we don't set up in the law firm for clients or provide a directed IRA, but it's legitimate and it's out there. It's a very unique.
We have done them. We
have, but we don't.
It's kind of like, it's kind of hit and miss. Clients liking it, not.
Yeah, they're very challenging, and so, but we have clients that do use them, and they're legitimate. They're just tricky. Guidant out of Seattle area is probably our biggest referral partner for that. We think they do a great job, and they've got a huge legal team to deal with the complexity of these. Now, what this is, everybody, is do it on your own research, figure it out if you want to, but it allows maybe this old 401k of yours or old IRA to start a business like a franchise of which you get to be an employee of it. You can never, ever be an employee of your own business owned by your IRA or prohibited parties and your IRA or 401k. You can't do that unless it's a ROBS structure, and it comes with its own set of issues. So here's the question from Tony. Best podcast ever. Thank you. I have a new client in his early 60s who bought a franchise about 12 years ago using a ROBS structure with his 401k. Now, what that means, to rephrase this, Tony, is he has a client who had a 401k that started a company of which he's an employee of. And that's really what a ROBS is. Your 401k bought a company, but you get to be an employee through this ROBS structure. It's a C corporation. And he wonders if it makes sense to maintain the Robs now that it's 12 years later, or if he should restructure his entity and implement a whole different retirement plan, blah, blah, blah. He's the only W-2 employee of this franchise, and his annual net income is around 50 grand a year. At this stage, what are the pros and cons of keeping the Rob C Corp? Well, this is a great question because the answer could take an hour. It's going to be very detailed and specific to this person's world. But I will say this in general, if you want to restructure it, it means shutting down the company, giving the 401k its money back, and it may mean selling the company and let the 401k have its money back plus profit. But think of it this way, again, your client doesn't own this company. It's his 401k does. The 401k needs to get its money back and it has to be shut down properly with no funky business. Then the 401k can move on and do something else. And if he says, well, I want to keep the business, I want to keep working for it. Well, then you're stuck doing what you're doing. You can't just unwind this deal without shutting down the whole company. But I would go to the provider that's working on your Robs, that handled the Robs, set it up, someone like this Guidant I mentioned, and let them give you the big list of pros and cons. Matt, what are your thoughts? Am I nailing that? It's unique.
Yeah. Yep. Totally agree. Robs are tricky. We might need to do an episode about those just in general. But they're a little tricky and have some quirks. And by the way, for any of you who are like, I never knew you could work for the company. It only works in a C Corp. It's a little clunky. It's kind of a very, very niche area where we think it works. So, all right, let me hit Larry's question. Larry has a great question. He says, my wife and I have self-directed traditional IRAs. Before she was my wife, she gave me a loan from her IRA, which is still outstanding. All right, that's very, very nice of her. And I love that two self-directed IRA investors got married. She says, I have an IRA LLC. We would both like to convert our traditional IRAs to Roth IRAs. Love where you're going there. And I would like to bring her IRA into my LLC so we can do real estate deals together. Whew. Okay, Larry, does her loan to me need to be closed out first before doing either? Can we amend my IRA LLC to include her IRA, or do we have to create a whole new LLC? All right, Larry, love this question. Now, you did one thing that makes this very complicated. You got married. And I know that changes the game in so many areas of what your life and relationship, and lots of positives. Love that. But it's getting clunky here, and I'm going to give you some answers you may not like because you got married.
And I think, but I will say this, Matt, maybe do it in steps. Because there are things you can do in this, and you're not in trouble because of that loan. Yeah. And that's grandfathered in. Yep. So can I say that part before you get?
Yes.
I'll just say this for any of you out there that received a loan or gave a loan to someone and then later got married to them, or they became a prohibited party, whether it was through a child's marriage, parents' marriage, some prohibited party that you normally couldn't give a loan to, but you gave them the loan when they weren't prohibited, you're okay. You're grandfathered in. So that's good. Now it's about what do you want to do with your new wife's IRA? Would that be fair to say?
Exactly. Yep. Yeah. And so now she is already a disqualified person. So whether you pay back her loan or not doesn't really matter because she's disqualified now. So now, can two disqualified people's IRAs invest into an LLC together? Yes. So you could do an LLC, Larry, with your IRA and your wife's IRA that's going to go into one LLC, and that LLC can go out and do the real estate deals together. Now that IRA LLC, we call a multi-member IRA LLC. We have a separate podcast episode just on this, and we're going to allocate the ownership in that LLC between your IRA and your wife's IRA based on the dollar amounts that you each put in from your respective IRAs. Now, what you cannot do though, Larry.
Bad news now.
Yeah, here's the bad news. Yeah, you cannot amend the IRA LLC that you already have with your IRA to bring her in later, because what that means is you're transferring ownership from your IRA over to her IRA. You guys are transacting between each other now in transferring and changing that ownership. That's a prohibited transaction.
Did you just say he was transacting with her now on a regular basis? Okay, let's
not get into that.
Okay, that was
not what I said.
That was very inappropriate. I can't believe you brought that up on this point. So yeah, the transactions you're doing now in a variety of ways are completely prohibited in the IRA.
Yeah. So, but now let's say you were not married. Let's say it was just you and girlfriend. That would be okay, actually. Yeah. You can have an IRA LLC with your IRA and bring someone over, or maybe it's a brother or sister who are not disqualified, or your friend or other investment partner you sometimes do deals with. They can come into your LLC and you could just mix up the ownership, but spouses are disqualified. So we can't transact between, we can co-invest. You can do a new LLC from the beginning where you break up the ownership based on dollars invested, because you're not transacting between each other. You're co-investing at the same time, taking original ownership in that LLC.
And I think there was a subtle point here that Matt said, it doesn't matter if you pay the loan off or not. I think a subtle point here is you want that money that you owe your new wife in her Roth IRA, you want to use some of that money to do real estate now. Well, okay, pay back the loan. Then her Roth IRA can go do real estate.
Right.
There's no other way to get there without paying the loan back. Yeah. So hopefully you've got a little nest egg somewhere to take care of her and get her paid back. Now, some clients may go take out a personal loan or an equity line on their home to go pay back that loan.
Yeah.
And that's okay too. Just shift whoever the creditor is. Shift it from her IRA.
Yeah, don't be it a loan that she takes out that then you use to then pay off her IRA. Not good.
Not good. Yeah, there you go. All right. Okay. Do you have another question?
Okay. Yeah. Let's see. Man,
I got the crypto mining. Did you see Tim's question on the crypto mining?
Yeah, that's actually one I'm looking at here.
Okay. All right. Go for it.
All right. So he says, I have a self-directed IRA with the rental property from another custodian and a self-directed IRA. Why are you using another custodian, Tim? Are you listening to their podcast? Are they answering your questions?
I know.
Self-directed IRA.
Ouch. Yeah.
And he said, I also had KKOS build a holding IRA and C Corp blocker for my crypto mining rig bought by the IRA. I'm having trouble filling out some of the forms. He talks about the W8, ENE, questions on how to answer. All right. Now, Mark, that form, you're familiar with that form that he's talking about. Yeah. Tim, you're getting caught up in the wrong form. And this is the problem using institutional accounts with crypto providers is they've kind of got square pegs and round holes systems of where you're putting stuff and what you need to fill out. And a lot of stuff doesn't even matter. That form is not going to matter.
Yeah, that form is about foreign entities, and a C Corp blocker is, I'm going to presume, has nothing to do with a foreign entity or foreign owner, because it's your IRA. Your IRA owns the C Corp blocker. So what's happened, and he says this in here in a very subtle way, I am having trouble with some of the forms, however, that Gemini recommends for an entity account, which is an institutional account. Yeah. So when anybody out there, when you go to fill out these institutional accounts with custodians or different wallets, they don't know who you are. So they're going to ask you a myriad of questions. And if you check the wrong box, it's going to send you down a rabbit hole. And so somewhere in that process, you checked a box that they think the owner is a foreign person or company. So you want to kind of unwind, start the process over. Hopefully you're not too far down the path with Gemini. I'd start a whole new institutional account application if they're now on the tail end trying, because once you try to explain what you did wrong in the application, it's usually just start over. So
yeah. Yep. Okay. I got another question from Alex.
Okay.
You ready on this one?
Sure.
Hi, Matt and Mark. He says, I have an existing traditional 401k from an old employer. I've been considering transferring to a self-directed Roth, which would mean you're going to have to do a Roth conversion. He says, while pondering this, my impression has been that having each individual contribution taxed is better than being hit with the lump sum tax when I retire. And now the actual question, drum roll, he says, am I correct? Is this the best move given the stated goals? Thank you both. Okay. This is a great question because it really gets into what is better, a traditional or a Roth. And we just happened to do a whole podcast episode on this, Alex, on when a traditional and a Roth beats out. And usually the Roth wins every time. Now, there's some limited situations where a traditional could be a good answer, but the hard and fast rule is better pay the tax now, let the thing grow tax-free, and come out totally tax-free in retirement. So taking the hit now, Alex, with that traditional 401k, rolling it over to a traditional IRA and converting to Roth, which we can do here. We call those just rollover Roth IRAs. We roll it into a traditional and immediately convert the whole thing to Roth. And then you start self-directing. And just think about this. Let's say that's a $100,000 traditional 401k from an old employer, and you want to roll it over now, pay the tax on $100,000. Let's say you're going to work, or let's say you have another 10, 20 years until retirement. And that 100,000 turns into $500,000. Totally reasonable to go from that to just investment returns over the next 20 years. Totally reasonable. Well, that 500,000 is all going to come out tax-free on the way out, no tax. If you left that as traditional and decided, I don't want to pay tax on the 100,000 now, I'd rather pay tax on the $500,000 as I'm pulling it out. That's going to hurt a lot more later on down the road as you're living in retirement, paying that tax as you're drawing the money out. So that's generally the concept is pay tax on the smaller amount, let it grow more, come out totally tax-free in retirement.
And I think something else here, folks, and it's one word, chunking. And I'm not talking about chunk in the movie Goonies by Steven Spielberg, an American classic. I'm talking about the fact that while you're younger now, before you start to take money out of a 401k, you have more options, more ability to be creative. For example, you can chunk over different amounts in a given year based on what bracket you're in. So you don't have to do it all at once either. Just do it in pieces. And number two, whatever tax you do pay on the amount you chunk is based on the fair market value of the IRA and what it's invested in at the moment you chunk. So the market could be down, real estate could be up, real estate could be down, who knows? So you kind of can be, within reason, pretty arbitrary on the date you do convert to Roth in the amount and how it's valued if it's in a unique investment. So but if you wait till later, when you're older, 59 and a half, and it's in a 401k and you just want to take money, all those options are gone.
Yeah.
So,
yeah.
Okay. I've got a fun one here too. This is,
okay.
We may be coming up on, well, maybe a couple more, 2 or 3 more questions. Okay. This is Matthew. He says, I just set up at Directed IRA. Thank you, Matthew. A Roth IRA account and also created an LLC with KQS for which the Roth IRA will invest its funds into. So his Roth IRA now owns an LLC. My question relates towards setting up bank accounts for the LLC. Now let's stop there, everyone, because once you form an IRA LLC, the LLC's now got to do business. It's going to need a bank account to pay bills. It might go buy real estate. It might open institutional wallets for crypto. It might open a Merrill Lynch account to just hold money in ETFs while I'm waiting for my next deal. You have all that latitude. So he says, if I set up a bank account somewhere, the LLC will receive a 1099 int. Or if I set up a brokerage account, the LLC will receive a 1099B for investment gains, all which report back to the IRS as income revenue for the LLC and subsequently pass through back to the Roth IRA. These would not apply to the Roth IRA. And I think what Matthew's trying to say is they wouldn't be taxable to the Roth IRA, but it doesn't seem like I am able to set up these accounts at a bank in such a way that would not generate these 1099s and complicate the tax reporting and maybe raise a red flag with the IRS. What are your recommendations here under this scenario? And Matthew, this is not to be offensive anyway, but it's trying to keep the show light. Basically, you're being a nervous Nelly. You're okay. You're okay. These 1099s that are being generated are going to the tax ID number of an LLC that has a non-taxable owner. And so they're just going to go into oblivion in the IRS system, and you're fine. It's okay. You can't stop the 1099s from happening, and there's not a red flag here per se. Sometimes the IRS doesn't know what they're doing and they might generate letters and ask questions, but there's no risk here of any harm. The concern I have, and I tell people when you do this, is when you're opening up these bank accounts and these custodial accounts, make sure your social security number is nowhere to be found. This is an IRA LLC, use that EIN.
Yeah, and the hard thing is those banks will need your social because they want to do that for know your customer and anti-money laundering rules. They need to know who the underlying individual owner of this LLC is. Where you're like, well, it's my IRA. Well, whose IRA is it? Well, it's mine. Okay, I need your social security number. They eventually got to tie every entity that they set up a custodial account for, a crypto provider, or a bank account. They got to tie that to a person at the end of the day. And so they may be getting that from you for KYC AML purposes, but you want to be clear in your tax reporting and when setting up the account, giving your tax ID, or if it's a single member LLC using the IRA custodians. I have the IRA custodians tax ID. I have an article called Properly Completing the W-9 form for your IRA LLC that goes through how to do this. It's on the Directed IRA blog and on Matt Sorensen's blog. Just Google for that and you can find it. Okay, I have a great question here from Joseph. This may be my last if you want to find your last question, Mark. He says, if my self-directed IRA is investing in a PPM that the firm I work for is offering to all employees, is that considered investing in a company I work for? And therefore I need to track the percentage of ownership I have and I don't get any benefits from the investments, make sure I'm not an officer, etc. Or since the transaction is technically an investment my firm is just managing, but do not have majority ownership, I don't have to worry about my status in the firm vis-a-vis any prohibited transactions. Okay, great question, Joseph. Now, let me hit where he's getting at with this for those of you who may be like, what is he getting at? When your IRA is investing in a private company, LLC, startup, private firm, PPM, we need to know who owns that. If Joseph owns the company, or Joseph and his spouse or any disqualified people own 50% or more, Joseph's IRA can't invest in it. Not a chance, not going to happen. Now, let's say Joseph owns less than 10%. His spouse or other disqualified people to Joseph are less than 10%. We're usually fine. Let your IRA invest, not prohibited. You're not in any position of control here. You have less than 10% ownership. They're offering shares out to investors. Your IRA can buy in. There's some cases and revenue rulings from the IRS on that. But if you're between this 11 and 49%, where you're like, I don't have more than 50%, but I got a little more piece of this than just 10%. Now we're looking at a gray area where it's like, all right, can your IRA invest in this company or not? Now, in Joseph's instance, this is actually a private placement. This is an investment entity that the company he works for is offering. Now, what I've done in that instance, and I've helped lots of clients on this, let me just say, anyone doing this, you're going to need a consult. This is tricky, but I want to kind of go over the parameters to think about. What the IRS is really going to look at, or where you'd have to analyze in tax court, was there any special deal that Joseph got as an employee in this company because his IRA invested, or that his IRA got because he had to work at this company. He got some sweetheart deal on the shares. So for example, Joseph, if this PPM is only offered to employees to invest their IRAs, that's not good. Okay, that looks like a sweetheart deal that only employees get, and you happen to invest your Roth IRA into it, or traditional even for that matter. So I don't love that. We generally like to be, my IRA is investing just like any other investor could come in to this PPM and buy. If that's the case, then I feel okay, because your IRA is not getting any sweetheart deal. It's getting the same deal any other investor got. Okay. Now, on the other hand, Mark's like, all right, I'm going to go. I know these consults usually take an hour. I'm trying to truncate this. On the other hand, the IRS, and there are some revenue rulings on this, where they basically say, hey, if your IRA invests in a company that's involved where you work, and that somehow makes your job a little more, secures your position a little more, gets you a promotion, gets you a raise personally at the company, they don't like your IRA coming in and investing in stuff that benefits you then personally at the company. Maybe you make a little more money in the fund or something. So we want to look at that too, to make sure there's no benefit going to you personally just because your retirement account invested.
The IRS basically doesn't like it when you sleep your way up the corporate ladder or use your IRA to schmooze up the ladder. Both are not good.
Either way, both prohibited.
Yep, both prohibited. Not a good idea. Maybe back in the show Mad Men, but not anymore. Doesn't work. So, all right. Well, I've got a good question here that I think is going to really, it's a good one to end on because I think it benefits a lot of every one of our listeners. You should take this away as a really good, juicy nugget. This is from Valerie. She says, hey, Matt and Mark, I just turned 59 and a half and I'm still employed as a W-2 employee. I am still making contributions with an employer match. Okay, now, this is so powerful because I'm going to stop right here and say this. Any of you that have a day job with an employer match opportunity, I don't care if you're 5 years old, 50 years old, or 95 years old, I call it matching out. Put in whatever you need to get that 100% match. You're literally doubled your money. Even if it's a crappy mutual fund they only provide in their portfolio, you still doubled your money. It's a no-brainer. So I would say, Valerie and everybody out there, no matter how old you are, if you're still a W-2 employee and you can get an employer match, at least contribute up to the employer match portion. Okay. Then she says, how much, if any, so this is good, can I take in distributions and convert to my brand new directed IRA crypto Roth account? Now, this opens up a lot of questions because the first thing is, this is where my mind goes first. Before we talk about taking money out of your 401k at your current job because you turned 59 and a half, and Matt knows those rules really well. I just want to say this, all of you, whether you have a day job or not, whether you have a 401k at your day job or not, and whether or not you're doing matching at your day job, everyone can have everyone can have a Roth IRA, a crypto Roth, a Roth you want to do real estate with, whatever you want. So you can open up a Roth, and because Valerie's over age 50, she can put $7,000 in that Roth, totally separate from her 401k at work. She has earned income, obviously, because she has a job. So all of you out there, the message that I would say is, before we talk about converting anything out of our current 401k, just know that all of you out there can have a 401k and a Roth. And if you have the financial wherewithal, I want you matching and maxing out your personal Roth every year. And it doesn't, again, matter what your age is, you just need that earned income and do it.
All right.
She wants to convert some. What happens when you turn 59 and a half? She didn't lose her job.
Yeah, you can roll out. So you can roll out any money in there. Now, if you're getting the match, sometimes there's some vesting rules where that's not fully vested, so you can't roll that out. But the rest of the funds in there, what's vested, employee contributions, once you're 59 and a half, you can roll it out when you want. Now, some providers will put a limit to say you can only do that once per year. So it's not like every time I throw in my contribution, I'm going to roll it out, roll it out, roll it out, roll it out. They might throw some restrictions on how frequently you do that. So just check there. And also remember, the match might have some vesting where it's not your money yet. It's in the plan and invested, but you could lose it if you don't stay employed there.
Yeah. And she said something interesting too. She said, take in distribution / convert. So if any of you picked up on that, not only does she want to take some out, she wants to put it into a crypto Roth, which means it's got to go from traditional to Roth at some point. Now, because it's in a 401k, she could go into her employer and say, convert X dollars to Roth, and then roll out the Roth to a Roth IRA. Or she could, we have a procedure, a directed IRA, just call the customer service. We've got a chat online, and they will help you get the right forms to roll it out to an IRA and then convert it to Roth on day 2. And you only have to pay one account fee to do that. We have a kind of a combo so that you can do it affordably. So you could do it in the 401k or do it after, but she's still got to convert it to Roth, it sounds like.
Yeah. Yep. And we can help with directed IRA. Just schedule a new account appointment online. One of our new account reps can handle that for you and help you get it done, help with the rollover. And then, obviously you got to get it converted. Now you do have to request the rollover because we can't get that from your 401k provider. So, but thanks everyone for all these awesome questions. We love getting them. We're going to get the site updated so you can get your questions asked online again. Get over to directedira.com/podcast to ask your questions. If you see other questions from other listeners that are being asked. Make sure you're voting on those or giving them a thumbs up. That helps us know which ones you guys want to answer. Otherwise, Mark and I are just, giving it a quick look and being like, this sounds interesting. It might help someone.
Yeah.
But what do we know?
Whatever. So, well, thanks everybody. And we'll see you next week. Self-direct on, invest in what you know, and keep living the dream.